And now for something completely different.
It's a rich man's world.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to Tuesday. That's right, it's technically speaking Tuesday. So our article is posted out this morning talking a little bit about the narrative, right? Is the narrative all priced in? And this is really kind of one of the big questions here, right? Because the month of November was one of the biggest surges in the month of November, like in history. It's one of the top three. And pretty much booked in about 2 years worth of gains in 1 month. So think about that for a moment. The average return of the S&P 500 over, the last 100 years is about 7%, right? You hear this number quite often. Well, in the month of November, we did about 14% in total. So about 2 years worth of gains all in 1 month. So pretty incredible. Put a chart out on that on Twitter this morning. But here's the important point about this is all based on narrative, right? So vaccine, everybody's going to get vaccinated. We're all going to go back to work. We're all going to be happy, healthy, honky-dory. And the economy will go back to growing at about 2% because that's where we were growing previously to this. So if we get there, right, economic growth is where earnings come from. Economic growth is weaker, so earnings growth has been weaker as of late. And you have to start asking yourself, is the market now beginning to already price in all the potential good news, right? So, it's a lot about stimulus and about QE, but if the economy recovers, well, you don't need as much stimulus or QE. So there's the give and take of all this. And so markets have really, really gotten ahead of themselves lately. But again, that's just the way markets react, right? Markets kind of overextend in one direction, then they correct, and then we go back the other direction. So what's happening right now, though, is that the markets have been really just kind of consolidating here over the course of the last 3 weeks. That's actually bullish, right? Because we had this very sharp advance in the month of November, and really over about the last couple of weeks in particular, the markets have really just consolidated these gains. And this is particularly because, we had the announcement by Pfizer, the announcement on the virus from Moderna and AstraZeneca. And of course, the markets have really just kind of really not gone much of anywhere between the previous tops in September and this new high that was put in by Pfizer here. We really just kind of have been going sideways. Now this morning, futures are pointing up, and that's not surprising. As we talked about yesterday, we did trigger a money flow buy signal. Money flows have been positive here. Even despite the little bit of a sell-off yesterday, flows into the market were actually positive. And so this is the first day of a new month. It's December. It's also my wife's birthday. Happy birthday, babe. And unfortunately, she's traveling now, so we don't even get to celebrate her birthday. But this is the first day of a new month. So not surprising, we're seeing money flows coming into portfolios here, managers putting capital to work here, make sure they have the right stocks on their books as they go into the month. Now, this doesn't set aside what we talked about yesterday, is that over the next couple of weeks, we do have a lot of mutual fund distributions. And so there's some divergences in the markets that are worth paying attention to that suggest there is some risk here, at least in the short term, over the next couple of weeks. If we take a look at the volatility index in particular, this is the VIX, right? That's at one of the lowest levels that we've had in years, right? So, I mean, we're pushing back down towards very, very low levels on the VIX. And if you take a look at the money flow indicators, it's about as negative as it can get. So what this suggests is that we're likely to see a pickup in volatility. Now, does that mean a major correction? No. It just means that basically we could see a lot more price sloppiness here, and we could see some downward pressure in stocks because of a reversal in volatility. So we could see the volatility pick up here. Now, one thing that would potentially cause that is a reversal in the dollar, because the dollar has been one of the trades that's been really kind of going on here lately, helping support the small cap value trade. Declining, weaker dollar has been supporting the energy and commodities trade. The dollar had a very sharp rally yesterday. And again, like the VIX, it's extremely oversold here in terms of its money flow indicators. So if we begin to see this turn up in the money flows going into the dollars now, and again, a lot of professional investors extremely short the dollar right now. So there's a lot of negative bets on the dollar, which is exactly what you need for a good counter trend rally here in the dollar. And that would also pull the steam out of stocks if that occurs, again, leading to a pickup in volatility, some correction in asset prices over the next couple of weeks. keep a watch on the dollar. It'll tell us a lot about what's going on. And again, even kind of watching the 10-year Treasury, we're seeing money kind of really, even despite the fact that markets are doing well here, money's been flowing into Treasuries here over the course of the last couple of weeks. Again, kind of that looking for that defensive kind of safety risk-off trade. And this also corresponds, if we see a stronger rise in the dollar, that'll mean more money coming in to treasuries, because that's where reserves have to be stored. So when they go into the US dollar, they wind up in treasuries, and that potentially will lift treasury prices here in the short term. So there's a couple of things that are certainly setting up here, at least for a short-term kind of correctionary trade in the markets. Nothing major, 3, 4, 5%. Not outside the realm of possibility in any given month, and particularly given the fact that we've just had an exceedingly strong month in November, a little bit of a give back in the month of December would certainly not be surprising at all. Doesn't mean it has to happen, right? But it wouldn't be surprising at all. So again, kind of looking at positions, taking some profits. This is kind of really the story that we've had in place here for the last couple of weeks. A lot of stocks have gotten very, very extended here over the course of the last few weeks because of this rally. Take some profits, reduce your position back to where it was originally. Raise a little bit of cash here, certainly won't hurt a bit. And as we go into the end of the year and begin to look into what's going to happen in 2021, then we can start kind of preparing for what happens next. So that's really kind of where things are now. On kind of some of the bigger stories that are kind of going along the markets right now, of course, is this idea of this continued economic recovery, right? And we're going to get the vaccine. People are going to go back to work. And again, as I said earlier, there's a lot of hope built into that, but yet we're already starting to see a contraction in some of the economic data. If you take a look at the economic surprise index, it's been turning lower. In other words, the actual data is underperforming what expectations are, and that's not surprising. We got very far ahead of ourselves in terms of the recovery as we got all the stimulus money that was going into the markets. That gave us a big lift short term, and as we always do, we always tend to extrapolate short-term good news driven by stimulus as to an organic recovery, and that's exactly not what it was. It was a stimulus-driven recovery. Good, nonetheless, but still it was driven by an artificial influence, not organic activity. And now that stimulus is wearing off here, and at the end of this month, that will be gone. And of course, one of the big risks coming up in January and really February, March, is going to be the lifting of the moratoriums on mortgages and rentals. So people that have not been paying their mortgages and not paying rent, and they've been under this protection of the moratorium, well, come January, that moratorium fades away unless it's renewed, and that means potentially people getting evicted, losing their houses, getting kicked out of apartments, those type of things. So again, that could certainly weigh on the markets in January or February if those things aren't extended, because again, unlikely Trump's going to do a whole lot here. With his term expiring, and Joe Biden doesn't take over as president until January 20th. There's a pretty big gap now between December and the end of January, where there's not potentially a lot of support coming in. Now, the good news yesterday, of course, and we've talked about this on the show, and I'm sure we'll visit about this again many times in the future, Janet Yellen officially nominated as Treasury Secretary by Joe Biden for his pick. And if she's approved for that, well, that suggests that there will be a hand-in-hand marriage now between the Treasury and the Fed, which means potentially, and this is one thing the markets do like about this, a whole lot more debt issuance. So, you want to fund anything, you need the debt to issue it, and now you got the one person in charge of the debt issuance, and that's Janet Yellen. The fox is now officially in the hen house. Quick break. We'll be back right after this quick break. Get by the website, realinvestmentadvice.com. Our Technically Speaking post is up. Lots of stuff to get into today. Don't go away. I'm your host, Lance Roberts.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Long-term care is the financial elephant in the room. The media median national cost of a private room in a nursing home? $8,517 a month. Are your finances prepared to handle that burden? Our next Candid Coffee with Richard Rosso and Danny Ratliff can show you how to protect your finances from the effects of a long-term care event, the myths to ignore, and how to prepare a plan to address the cost. Register for the special long-term care edition of Candid Coffee, Saturday, December 5th at riaadvisors.com.
You're listening to The Real Investment Show.
A modern day warrior, mean stride. Today's Tom Sawyer, mean ride.
And welcome to the show this morning. It is 6:17 on this Tuesday as we get it up and get it on for the day.
Yeehaw!
It's the third best day of the week.
Already.
Tomorrow's hump day. So we're getting there. Today's Technically Speaking post is up and on the website right now, realinvestmentadvice.com. And one thing that, as I was writing this article yesterday, I was, kind of going through the data. And, it really kind of dawned on me, right? So we started talking, I'm writing about this, this idea that the markets have, pretty much priced in all the good news. Right? I mean, it's really not what good news are you going to have from here to keep the thesis going that, things are going to improve, right? So, you've got a vaccine coming, right? We're pricing that in now. And of course, with that, you're pricing in the economic recovery. We had one of the largest monthly jumps in, stocks since, 1930. So, you've done a lot, right? So in terms of valuation and expectations, those type of things. And so, as I'm looking into the data and I'm analyzing this and starting to look at, what we pay for, right? What we pay for when we buy stocks is we're investing in the future cash flows and earnings of those companies. Now, we forget that most of the time, right? So, we buy a lot of companies right now simply because they're going up. They have no earnings and no real value, but we buy them simply because they're the hot stocks, right? And this is very much the sentiment-driven idea of the market, right? Everybody's very bullish, very exuberant, so we're just investing money in anything that's kind of going up, right? And it doesn't really matter if there's a fundamental story to it or not. We buy it anyway. But this got me to thinking a little bit about, justifications, right? At some point, we do have to justify what we're paying for. As Warren Buffett once said, price is what you pay, value is what you get. And so I went back to January of this year, and I looked at what earnings estimates were in January of this year. Now, this is pre-pandemic, right? Market had a big return year. Don't forget, it's 2019. The market was up over 27% in 1 year. Huge return year in 2019. Expectations, of course, were high because we'd had the tax cuts for corporations, right? So corporations were paying lower taxes. We were just finishing up. Remember, all of 2019 was about the trade deal, right? We got this trade deal we're going to do with China, and that's going to be great for U.S. companies. So we got the trade deal getting wrapped up in December. We've got tax cuts, and then, of course, we've got the Fed in doing repo behind the scenes for some reason because everything was supposedly fine. The Fed's in there doing some emergency work behind the scenes, but injecting liquidity into the markets. Sure, yield curve was inverted, but who cares? Market was up 27%. Analyst estimates for 2020, my apologies. The estimates in January for the end of 2020 for the S&P on a reported basis. Now, this is reported earnings, not operating earnings. This is actually in your pocket earnings, not fantasy earnings, right? Reported. The only thing that matters. At the beginning of the year, they were expecting $167 a share in earnings for the S&P. Now, the market is up roughly 12% for the year. So you're expecting earnings to grow to $167 a share in 2020.
and you run the stock price of the market up 12% based on that earnings expectation. The problem is that earnings are not $167 a share right now. They're at $93.16. That's nearly a $70 difference. Actually, it's more than $70 difference in earnings, but yet the market's 12% higher. You're paying 12% more for the market with almost 30% less in earnings. And so this is the problem. Okay. But yeah, 2021 is going to be better. Right? Earnings are going to recover. Probably. Get a little bit of economic recovery. Yes, you're going to get some economic recovery. Okay, great. Let's go with that story for a moment. By the way, right now you're paying 30 based on the current price of the market and what estimates are expected to be at the end of the year. We're trading at 38 times earnings. Now, valuations doubled. PE at the end of 2019 was 19 times earnings. So you've doubled valuations in 2020. So in January of this year, like I said, we were expecting $167 a share in earnings. Expectations for 2021 are $171 a share. Okay, that was the original estimates for 2021 were $171. So we started this year at $167 for 2020, and when we started putting out estimates for 2021, S&P had $171 tagged for that. Markets are up 12% year to date, and yet we were only expecting a $5 per share increase in earnings for 2021. Problem is now that those estimates are no longer viable. Those estimates have now fallen about $30 a share to $143 a share in 2021, which puts our valuation, if we even get to that number, right? If we can get to $143 on a recovery, so that we have the economic recovery and we go from $93 a share back to $143, right? So we have, this $50 increase now in earnings per share. And if we get that, if we actually make that trip, we'll be trading at 27 times earnings. And that assumes that we don't increase the price of the market from here at all. Right? In other words, the market doesn't move higher from here. You're still trading at 27 times earnings on a forward basis. The problem is, so I went back to 2013. And I said, okay, let's look at the initial earnings estimates for the year. I've got all these charts, by the way, they're in the report today. Right? So if you go to the website, realinvestmentadvice.com, I've got all the charts and tables there for you. So you can look at the math. So I went back to 2013. I said, okay, let's take the original estimate of the analyst for each year, right, up to date, and look at where we wound up, right? How close were the estimates? Because if we're looking at an estimate today and saying, okay, great, earnings next year are going to be $143, awesome. How accurate is that? So I went back to 2013. The average miss by analysts is 30%. In other words, they start out 30% too high and it gets lower. Now, it's not always 30% every year, right? 2013, they were too high by 12%. 2014, they were too high by 17%. 2015, they missed it by 70%. 2016 was 30%. The closest year they got was 2018. They were only off by 3% between the beginning and the end. That was the closest year they got. Every other year has been very, very wrong to a large degree, 70% for 2020 so far. And expected right now, they're off about 22%, where we are at this point. That's probably going to get worse. But the point here is that the estimates are always overly optimistic. And this is where we get into trying to justify our investments. Wall Street's not on your side, right? Forget that Wall Street is there to help you, because they're not. When you look at a list of their priorities, right? Retail clients are at the very bottom of the list. You're basically who they are selling product to. They're creating product, they're IPOing companies, etc. They're making the guys that own these companies uber wealthy, and they're selling the actual shares to you, right? You're the cannon fodder for creating wealth on Wall Street. If you don't believe me, over the last few months, the owners of these companies that you're chasing, wildly after, have increased their wealth by $1 trillion. So we've made these CEOs of these companies, and some of these are marginal at best, as I said earlier. We've made these companies, the owners of these companies and the employees of these companies that own the stock, very wealthy. They've fared very well from all this, and that's because we're buying those stocks, right? We're chasing those stocks and we're driving up those prices, and an insider selling right now is at an all-time record. So as you're chasing these stocks higher, insiders of these companies are going, "Yep, I'll sell it to you. I'll sell it to you. I'll sell it to you," and we're making these insiders of these companies very, very wealthy by chasing these stock prices. But again, we're not really paying attention to the fact that we're way overpaying for the value of these things. There's been a lot of talk here lately about the value trade, right? We're going to buy these undervalued stocks. These stocks aren't undervalued. A lot of these stocks are extremely indebted. In fact, they depend on debt for their very existence. And the prices of these stocks have run up to a degree that really the value is no longer there. In fact, we wrote an article about this yesterday, calling about the end of the Widowmaker trade, which is this whole idea that the value trade is coming back. Maybe not. It seems like right now we kind of have that going on. But again, when you get back to looking at the fundamentals and actually what you pay for, that's an entirely different story. Anyway, articles on the website. Is the narrative kind of all priced in at this point? And the answer is probably yes. But again, markets can remain irrational, a lot longer than you think. So we're going to keep trading it until we have to. All right, be right back after the break. I'm your host, Lance Roberts. Don't go away.
You're happy when I'm on my knees. One day it's fine and next it's black. So if you want me off your back, well come on and let me know. Should I stay or should I go?
Listen any place, anytime at realinvestmentadvice.com.
Long-term care is the financial elephant in the room. The median national cost of a private room in a nursing home? $8,517 a month. Are your finances prepared to handle that burden? Our next Candid Coffee with Richard Rosso and Danny Ratliff can show you how to protect your finances from the effects of a long-term care event, the myths to ignore, and how to prepare a plan to address the cost. Register for the special long-term care edition of Candid Coffee, Saturday, December 5th at riaadvisors.com.
Got questions for Lance later? Ask now at realinvestmentadvice.com.
And good morning. Welcome back to the show. It's 6:33 as we get this Tuesday underway. I said earlier, markets are pointing higher this morning. Not really any news out to speak of. Just really it's kind of the first day of the month. And as first days of the month typically go, particularly as we had a little bit of a sell-off yesterday. Not big. Had a little bit of a sell-off in stocks yesterday. Kind of the bigger sectors hit yesterday were the international markets because of the big jump in the dollar. So you had a big jump in the dollar yesterday that impacted emerging markets, international markets as well. Weighed on commodity stocks. Energy stocks were down sharply. You see you get a little bit of a reversal today. Again, just as mutual funds and pension funds, those type of things, they typically take on bets right at the first of the month, depending on what their outlook is. But that really doesn't negate the fact that we've got a lot of rebalancing to do. over the course of this month. After a big gain like we had last month, mutual funds need to rebalance. And also we've got distributions coming up. It's the end of the year. So we've got distributions coming up. Pension funds, again, they have to rebalance. Mutual funds have to make distributions and rebalance. So, there's, despite the fact that today's going to open up strong, it's going to be a question of whether or not we can maintain it throughout the day. Is one thing. We've seen these kind of openings before where the market opens up like 1%, we sell off most of the day. Not saying that's going to happen, but we've seen these days before. But it also doesn't mean that today's gain can't be reversed over the course of the next few days. But again, nonetheless, markets are going to open up stronger today, which is good news. And this is where you have some opportunity here. And as we've been talking about, really kind of when you look at the markets, and again, if you in our Technically Speaking post today, we've got 3 charts in there in particular, which are looking at deviations from long-term means. So, for instance, if you take a look at a daily chart of the S&P 500 right now, it's trading nearly 15% above its 225-day moving average. So that's basically its 1-year daily moving average of trading. And so when you start thinking about that and looking at that deviation, you're 15% above, that's a level that has only happened a few times historically, going, all the way back to 1960. And when you get these types of deviations, it doesn't mean you get an immediate correction, right? It doesn't mean you immediately, oh my gosh, we're going to have a 2009 crash. But it has typically aligned with at least short-term peaks in the markets. In fact, the last time that we were this extended was in September, and we had a 10% correction, right? Same thing goes with the weekly, right? So if we look at a 1-year moving average on a weekly basis, right, 52 weeks, the market currently is running just slightly below a 15% deviation above that 1-year moving average. Now, again, this is essentially what's happening in the markets. To put this in simplistic terms, is you're trying to stretch something as far as it can go in one direction. So think about a spring or a rubber band, whatever it is, and you pull it as far as you can in one direction. Well, it's got to relax before you can stretch it again, right? And there's a point to where you stretch it and ultimately it breaks, right? So you can only stretch something so far. And that's really the way moving averages work within the markets. They're kind of the gravity. So when you stretch something, when you stretch price as far as you can above those moving averages, that gravitational pull, that desire to come back to that moving average increases. And the reason it's an average, remember, the reason you have an average is that prices have to trade above and below that average over a period of time. Back in February of this year, we were warning about a potential correction in the markets. And there was really no worry here. We weren't worried about a pandemic in February. And we wrote an article talking about why we were taking profits. Markets were too overly extended. And we were about at this same level back in February of this year. And we corrected not only back to that moving average, but well below it. Now, that doesn't always happen. You don't have that type of extreme contraction. It does occur historically, but not that often. But generally, when you get very, very far extended above these long-term moving averages, you get at least a correction back to the moving average, if not slightly below it, right? And that's why moving averages are rising over time, because you're slowly bringing that average up, because you're not correcting always below it. But you do consistently throughout history come back and retest those averages. Same thing on a monthly basis. Right now, you've got a monthly extension that is currently about 17.5% above the 2-year monthly moving average. Very long-term moving average here, right? This is an extension point that you rarely see. Last time you saw this was in January of 2018, and we had about a 20% correction. So what I'm telling you is I'm not trying to scare you. I'm not trying to be bearish. I'm not telling you go cash out everything and go hide in gold and silver, right? I'm not saying that at all. All I'm saying is that there's a lot of good news, as we were talking about in the last segment, pretty much whatever you look at in the markets, right? Whether it's, recovering earnings or recovering economic data, more stimulus, whatever it is that is your particular news du jour, that is your support, your rationalization for current prices, that's priced in. You've stretched that rubber band as far as you can. So the point here is that if there's something that comes in that is disappointing, right? We don't quite make those earnings numbers. We don't get the amount of stimulus that we're expecting, right? Maybe we get stimulus, but it's only 500 billion, not 3 trillion, right? There's lots of room for disappointment. And when you have that room for disappointment, that's how you get a correction in the markets. And that's why, when you look at any great historical money manager or trader, right, throughout history, they have some very simple rules. And one of those rules is always, buy low, sell high. Problem is we always forget the sell high part, right? So we do a pretty good job of buying. Most people do a good job of buying. Problem is they forget to sell. And, you're not always going to get it right. I mean, the beautiful thing about investing is that you don't have to always be right. You can be a very successful investor and only be right 70% of the time. You're not going to get every trade right. And that's the important thing here, right? Not every trade is going to work out exactly like you plan it to work. And that's okay. But that's why you have stop losses. That's why you have rules around managing your portfolio to limit the capital destruction if something doesn't work out the way that you expect it to work out. But that's the point of investing, right? We have to have these rules. The problem for most people is that when markets are going up, it's great. It's fun. It's exciting. It's exuberant, right? I mean, I'm just, I love looking at my portfolio every day because the markets are going up. What we don't like is when it goes in the other direction and we haven't taken any actions to protect that downside. So we wind up potentially giving up a lot of our gains. Again, look, sometimes that's going to happen, right? Just when you're managing your own money, even when somebody else is managing your money, mistakes are going to happen. That's just part of the game. And you have to understand what the rules of the game are. And this is, we write a lot of articles about rules. In fact, we just posted just recently in last weekend's newsletter on our website, 7 impossible trading rules. The reason they're impossible trading rules is because our psychology keeps us from actually trading as we should and investing as we should. And don't construe trading and investing as two separate things because they're not. Whenever you invest, you're trading, you're buying something. Right. And what Wall Street wants you to do is they tell you, well, just buy it and hold it, never sell it. Right. They're good for Wall Street, not so good for you in a lot of cases. We're all ultimately speculators. We have no control over what companies do. Warren Buffett's an investor. Right. He buys whole companies. And, as I said before, when Warren Buffett invests in the company, he goes into the boardroom and says, OK, you at the head of the table, that's my chair. And he runs the companies, right? Or he appoints people to run those companies that work for Berkshire Hathaway. That's investing, right? Because he has the ability to adopt strategies and make changes to these companies and the way they behave to make them more profitable. He has the ability to combine a company with another company that he owns to make them more profitable. He has tactical advantages. You don't. All you do, and all I do, right? We're all the same. All we do is buy pieces of paper at one price and we hope to sell them at another. That's the best we can hope for. That's all we can do. And we have to maximize that opportunity as much as we can. And we're not always going to be right. Even Warren Buffett makes mistakes, right? Warren Buffett owned a bunch of airlines. Didn't plan on the pandemic, but, happens, right? So he sold a lot of those investments. Everybody makes mistakes. Even the great Warren Buffett makes mistakes. But that's part of the game. And if you're not willing to accept those mistakes and make those mistakes, A, you're not ever going to build wealth. And 2, you're deluding yourself ultimately to the point that you're going to wind up hurting yourself more than anything else. Understand you're going to make mistakes, but have a strategy and a discipline to deal with it. And that's why we post these rules out regularly. But this is that point in time where exuberance and excitement and bullishness start to cloud our better judgment about managing the risk in our portfolios and saying, man, I should really, when you hear that little voice saying, man, I should really sell a little bit of this, that's your subconscious going, you should really sell a little bit of this. Don't let the other part of your conscious tell you not to. Be right back after the break.
You're listening to The Real Investment Show.
Long-term care is the financial elephant in the room. The median national cost of a private room in a nursing home? $8,517 a month. Are your finances prepared to handle that burden? Our next Candid Coffee with Richard Rosso and Danny Ratliff can show you how to protect your finances from the effects of a long-term care event, the myths to ignore, and how to prepare a plan to address the cost. Register for the special long-term care edition of Candid Coffee, Saturday, December 5th at riaadvisors.com.
Life is a series of events. How long will your retirement last? More importantly, how long will your retirement funds last? You can plan for a successful retirement with RIA Advisors' free financial planning tool, MyBlocks. It's our online modular manager for your money and your life. Does your vision of retirement match up to reality? MyBlocks can help to determine how much you'll need and how to achieve that goal. Create your own personal financial vision for the next decade with MyBlocks, our free tool at riaadvisors.com. That's riaadvisors.com.
The Real Investment Show.
And welcome back to the show this morning. So again, the article's out on the website now talking a little bit about, is the narrative all priced in? And again, the whole point of this is simply just to, kind of keep some kind of logic and rationale kind of wrapped around, what's going on in the markets. It's very easy to get excited. And again, we're invested in the markets. We're long markets. We've taken little profits here and there. On things that were grossly extended, and we'll look to add back to those on a pullback. And that's just, as I said, that's just kind of part of the management of a portfolio over time. Doesn't always work out exactly like you plan, right? I've talked about this on the show before. Is that they did a study back in the late '90s, and they went and studied people that make forecasts, right? So they studied weathermen and palm readers and tarot card readers and psychics and, all these people, everybody that makes a prediction, right? They found people and they interviewed them and they tracked their predictions over a period of time. And that includes stock market analysts. They found out that the best predictors of the future, believe it or not, are weathermen, meteorologists. I know we should be more PC. Weather people, right? Weather persons.
Yes.
But that's what they found out. And in fact, their predictions are accurate up to 3 days in advance. They were more accurate than tarot card readers, psychics, stock market analysts. Much more accurate. So the point is that we don't know what's going to happen in the future. What we do know is that we can look at the past and we can say, okay, based on statistics, this typically happens more often than not. And that's really kind of what stock market analysts kind of hang their hat on, right? Next year is always going to be a bullish year. No matter what analyst you talk to from a Wall Street firm, next year is always a bullish year, right? Next year, we're going to be up another 10%. Next year, we're going to be up another 10%. And the reason they tell you that is because they need to sell you product, right? They need you to be bullish as well so they can sell you product. That's what they do. They sell you ETFs, they sell you mutual funds, they sell you IPOs of companies. And think about it. Why does a company go public? Is the company going public just to make you money, right? Airbnb is about to go public, okay? Their bookings are down 70% over the last year because of the pandemic. Nobody can travel, right? So now they're going public. They're going to sell you shares in their company, ranges $40 to $50 a share. So you can buy into Airbnb. Why are you being so fortunate to be able to invest in Airbnb? Because the insiders, the people that invested in Airbnb to start with as a private equity investor, are cashing out. Where do you think the shares come from that you buy? They don't magically appear. These are people selling you the shares. And are they selling you these shares at a discount? I mean, are they going, you know what, Brent's been a good guy. We're just going to lop, 70, 80% off our valuation. We're going to sell shares to Brent really cheap. No. They are trying to extract the highest possible premium out of their business. And that's why they sell you the shares. So this is what's called investment banking. This is what Wall Street does. They create product, and in order to monetize these shares, these insiders of these companies have to have somebody to sell them to. Now, they could sell them on the private market. That's a more difficult transaction, especially when you're talking about the size of some of these transactions, billions upon billions of dollars in size. Or they can sell them to the public market. Much easier. Wall Street makes a lot of money doing these transactions and selling you the shares. So yes, you get the benefit of being able to invest in Airbnb. But just remember that you're doing the insiders of these companies a huge favor by buying their shares at an elevated price. Now, typically, it all works out fine, right? Company goes public, shares keep going up because people keep buying them over time, yada, yada. And we get into the greater fool theory. Somebody's always willing to pay a higher price than you, so you sell them to somebody else. But just always remember that, Wall Street's not there for you, so you have to do a little bit of the homework and a little bit of the understanding and the risk management yourself. And that's really the whole point of what we talk about here. The reason that we talk a lot about risk is to help you pay attention to those things that could go wrong, right? November was a great month, right? We had a great month in November. Totally forgot about what happened in October. A lot of people didn't like that 10% decline in October. Didn't like that 10% decline back in September either. Those 10% declines can happen out of nowhere, right? And fortunately, the market recovered and we got back to all-time highs. But these 10% declines, they don't feel good when they happen. And we typically make mistakes when we get into the middle of those declines, but then we quickly forget about it when the market's going up. It's like, what 10% decline? Totally forgot about that, right? Totally forgot about the 35% decline back in March. What decline? Yeah, completely off the radar. But these things happen. And that's why, we want to, and this is why we try to get you to just continue to at least just take a step back. I know it's very easy and it's easy to get excited and exuberant. I mean, I love it when, I buy a stock and it goes immediately up. That's awesome. It's fun. But that's the speculative, that's the gambling part, right? That's the part that, the flashing green lights and all that on their screen. That's the fun part, right? That's the dopamine effect of investing. But just don't forget that there is a risk to investing. And what you're playing with is real money. This isn't really a game. This is actually real money that has a long-term effect. And, when you wind up destroying $2,000, $3,000, $4,000, $5,000 of value, over 30 years, that's $30,000, $40,000, $50,000 worth of value that's been destroyed. And eventually, yes, you'll get back to even, but you've lost the time in getting back to even. So you didn't really make money getting back to even. So this is why we kind of go back and we just talk about, try to keep some rationality between what's actually happening in the markets and the economy versus what you're paying for. Exuberance is very high at the moment. Confidence is very high. Investors are as they're all in. If you take a look at the level of professional investors, they are not only all in, they're all in and leveraged. They're 103, 104, 105% long stocks right now. The individual investors have surged in terms of bullishness over the last month or so since the election. So everybody that was potentially out of the market has now been drugged back into the market. And what that provides is the fuel. You know, we've talked about this before on the show, talking in relation to margin debt, but it works in a lot of the same manners. If I have a can of gasoline, I can set it in my garage, and I don't really have to worry about it. Just don't set it next to the heater, right? But I can have a can of gasoline in my garage, and it's completely inert as long as it's in the can, stored properly. I don't have to really worry about it too much. That's the market, right? And when you get more and more exuberant about the market and get longer and longer and longer into the market, that gas can is becoming more and more full. And what it takes to light or to ignite that gasoline is you need a catalyst, right? Something to interject into that process and start the chain reaction. And that catalyst is what creates the explosion with the gasoline. Same thing with the markets. The gasoline for the markets, the fuel, is completely inert. As long as prices are rising and people are exuberant and everything else is going accordingly, prices can keep going up, and they can go up and they can get more extended and more exuberant and then and further extended than you can even imagine. But it's completely inert as long as a catalyst is not introduced into the markets. And right now we've got a long list of catalysts, right? Disappointing economic data, disappointing earnings data. There's, something happens, politically, something happens financially. I mean, there's just, just a tremendous number of things that could cause a change in attitude. And that's all we're talking about here, right? Because markets are driven by sentiment. And right now, sentiment is as bullish as it can get, right? Everybody's technically on one side of the boat. And what you need is some unexpected exogenous event. Never know what it is. Nobody counted on a pandemic back in March. You have this unexpected event that shows up, and all of a sudden it changes sentiment. It changes attitude. And it starts out with one guy on the boat going to the other side of the boat, and then the entire herd runs with him, and the boat tips in the other direction. So that's how markets work, and they're driven very much by sentiment. And so part of the trick to managing markets and managing portfolios is to watch the sentiment and watch for changes in sentiment that something is going back in the other direction. And that's your first kind of warning sign and clue. We don't have that at the moment, but it's something with everybody as bullish as they can get right now. The market is set up for a very quick reversion, and all it needs is a catalyst to change sentiment. Wraps up the show for today. Get by the website. Our Technically Speaking post is up and running this morning. It's on the website now, realinvestmentadvice.com. While you're there, send us your questions, comments, emails. Let us know what we can do to help you. Always happy to help you out any way we can. Get lots of questions every day. We answer every one of them before the day is over. So send us your questions and comments. Happy to help you. realinvestmentadvice.com. Have a great Tuesday. We'll see you tomorrow on the next edition of The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
It's a rich man's world.